You're watching BCTV. We're all about Branford. You're watching BCTV, Branford Government Television, a service of Branford Community Television. This program is brought to you in part through the support of the town of Branford.
So we're going to start the Town of Branford Board of Finance remote special meeting for December 7th, 2020. And this is a fully remote meeting for the Board of Finance and will be on BCTV, Comcast Channel 20, on Facebook Live, and obviously on Zoom, which we're on now. First on the agenda is citizens' comments. And we ordinarily set aside some time for citizens to participate and have comments or communications with regards to agenda items. Is there anyone who would like to communicate to the board at this time? Not hearing anyone wishing to address the board, then we'll move on to the next agenda items, which is item number 2, is to hear a presentation from the Andreol Group and GYL Financial Synergies with regards to the performance of the Town of Branford Police Pension Fund for the quarter ended September 30th, 2020, and if necessary, rebalance the portfolio. And that's item number 2. And then we'll move on to item number 3 with regards to the volunteer fire incentive plan. And agenda item number 4 is to hear a presentation with regards to the other post-employment benefits, the OPEB fund. So with that, I will turn it over to the folks from Andreol and GYL. I'm not sure who's going first. Is that you, Charlie? Or
I'll kick us off. This is Robert.
Thank you, Robert.
So as customary, so Charlie and myself will cover the backdrop of the market environment for the period ending September 30, 2020, as well as provide some additional detail through the current market day. And Luke will talk about specifically the performance and the experience of those 3 funds, the police pension, the fire incentive pension, and the other post-employment benefit trust. And then we'll also touch on any rebalance or adjustments within each of those portfolios. So as we all know and have lived, this has been a very chaotic year, to say the least. We've had significant volatility continuing through the third quarter of 2020. And volatility isn't always necessarily just the market declining, but also the market going higher. So we've had the market moving higher and having some reasonably high volatility days. But it has continued to improve off of those lows that were made in March of early this year, where the market was down at that point about 32%. And now as we look at it through the end of the quarter, as well as through year to date, through the end of the quarter, the market, as we like to talk about it, was up about 8.93% for the quarter ending September 30, bringing the year to date return through September 30 to up 5.5%. But if I bring that through today, the market's up 16.25%. So we've had a tremendous environment to navigate. And when I talk about the market, I am referring to the S&P 500 as just a broad measure of the stock market. We've had some pretty tremendous events that we've gone through, from how significantly down the market was to how it's advanced. During the quarter, the most recent quarter, in the U.S. equity markets, large equities did much better than mid and small. And what was interesting is that emerging markets, actually, the developing markets globally, perform much better than even the U.S. markets. being up about 9.5% for the third quarter of 2020. The story's changed a bit as we go into from September 30th to today, where we've seen over the last 2 months a pretty big move in small and mid cap stocks as they've moved also towards new and all-time highs. So very good activity and positive experience in the equity markets. And in the fixed income markets, we've seen a similar type of story, while not as dramatic, but we've seen the fixed income markets up over 6% in aggregate this year as a result of the decline in interest rates that happened early in the year, as well as the tightening of credit spreads, meaning the risk premium assigned to corporate bonds. Those risk premiums have declined, meaning those prices have gone up, which is added to return. So these are good things that have helped all three of the funds that we're going to be talking about over the last 3 months, as well as over the last couple of months and then year to date. So very good in that regard. Economically, we've seen in the Q3, we saw a big snapback in the gross domestic product, with the quarter over quarter being up 33% for the US GDP. Now that's on the heels of being down 32%. So, that's still quite significant. The fourth quarter GDP forecast is for another 4% on top of that, bringing our full year forecast to negative 3.6%. So for the full year, a contracted year, albeit at an improving rate at this point in time. What is interesting to note is the expectations for how the year ends with regards to US GDP have been improving. When we looked at this last quarter, the expectation was that GDP for calendar year 2020 would be negative 5%. That expectation is now negative 3.6%. We're seeing an improvement in underlying economic fundamentals, and that's continuing to be additive. The unemployment rate has continued to improve. We're down to under a 9% unemployment rate and expected to see that number continue to drift lower towards 7% between now and year end. We've seen stabilization in the energy markets, which was a challenge early in the year, where we saw crude oil prices decline over 50%. And that has stabilized, and we've seen those big energy companies improve slightly in price. But that is definitely the worst and hardest hit sector of the US stock market, and parts of the economy have significantly been impacted by the energy issues that happened early in the year. So the topic that front and center for everybody's mind is the impact of coronavirus on the economy. So as they are tracking with a vaccine or multiple vaccines through late stage trials that they're accelerating through, and are starting to see adoption into various countries around the globe, that is one of the things that's leading to increased expectations for gross domestic product, increased expectations for corporate earnings over the next 6, 12, 24 months. These are positive things should everything play out as is being expected at this point in time. So another big thing that we've gone through over the last month that everybody's well aware of is the election cycle. I don't need to recap it. We all know where we stand and the status of things. The commentary that goes with it is we believe is very beneficial to have a divided Washington, where the president and at least the Senate or the House is of opposing parties. It means that any major policies need to see more governing from the center to see anything that's substantial for change. So we think that will help us stay with some good underlying tax code and regulatory environments for the near term, which is helpful and beneficial to corporations. Which leads me to valuations on equities. We believe that PE ratios may seem a little high at the moment in the low to mid 20s. That's based on trailing earnings. As you start to look forward to what earnings are expected to expand and grow, when we look at forward earnings, we're looking at a PE multiple on 2022 earnings that starts to come down towards 18. So we're seeing, the ability for these companies as they continue to grow, that their valuations seem fairly valued and that there's continuous upside. a challenge and a headwind that all these portfolios will face is going to be the fixed income portion of the portfolios. Even with a very conservative bias as is in place here, we're at close to 0% interest rates on the very, very short end. And we've seen interest rates over the last couple of months start to edge higher in the 5 to 10 year and 30-year part of the yield curve, albeit not substantially, but enough to be notable from the investment side, as we see the 10-year Treasury trying to approach 1%, which is an increase from earlier this year where it was closer to 0.5%. So as interest rates move higher, bond prices will decline, an inverse relationship. And also at a point in time in the future, we may see, how long can we stay at 0% interest rates? It could be a while. That's the expectation currently, but when that does change, rates will move higher, which will cause bond prices to decline, which is going to make the fixed income portion of the portfolio a bit challenged to provide any return in excess of the coupons that we're able to carry from the bonds that we own. But we think that the manager is positioned well with regards to the credit exposure and the duration, staying more conservative. So we're not exposed to the lower credit end of investment grade across the portfolios, which gives us some comfort as we navigate these times. So with that, I'll let Charlie if he has anything else additional to comment on there. And I covered a lot before we switch over to Luke.
Thank you, Rob.
Yeah, sure. Obviously we went through, no matter what side of the aisle you were on, a fairly traumatic election cycle, campaign and election cycle. And it's fairly obvious that Joe Biden will be the president, and the market is trying to deal with what it would have been like to have Trump as the president for a second term, or Joe Biden for a second term. And the policies that Trump had, deregulation, lower taxes, both corporate and personal, were all very positive for the economy and the underlying markets, which led to a belief that a Biden administration would be, negative for the markets and the economy. And that's not necessarily true, and the market is starting to reflect that as it continues to advance, and with an understanding that Joe Biden will be the president. So, and one of the reasons for that is the fact that there will be significant spending in Washington. Money that goes out will be spent on goods and services that will improve both GDP and earnings for various companies, or most companies. So the narrative that implied that if Biden won the election, that it would be not good for the market is turning out to not necessarily be the case. Now, if 3 years from now, our deficit is, $500 trillion, or, I don't even know what the next increment is, that'll be an issue. But to the extent that we have targeted spending, infrastructure spending, as well as, which would be very positive, which was part of the Obama administration but never got executed, as well as spending for relief due to the COVID situation, and then spending on other targeted initiatives. It's our view that it would be very positive, for the markets. And you take into consideration the the very, very, very low yields in bonds, and the fact that there's really no other place to go to get a reasonable yield, and probably not for a while because we don't see bonds turning around in terms of yields in the near to intermediate term. And then there's going to be a lot of flow into stocks, and so that will buoy the underlying stock market as well. So we believe stocks are a good place to be. As you know, they don't go up, in a linear fashion, and that there's always degrees of underperformance and outperformance. But over the long run, I would say next 2, 3, 4, 5 years, we believe that stocks will outperform bonds by a significant margin.
Thanks, Charlie. I think we'll listen to I don't know who's going to make the other presentation with regards to the funds, but at some point in time, maybe down the road, we talk about any of the policy that we have with regards to investments. If in fact the bonds are going to be giving us such a low return, that could impact budgetary considerations going forward over the next couple of years.
Right.
But that's for another day.
Okay. It's something we're very familiar with. We've been discussing it with our clients for the last 3 to 4 weeks or so. So I understand exactly what you're talking about, and I'm willing to talk at any time.
Thank you.
So Luke, do you want to take over and take us through the experience of the fund, starting with the police pension?
Yep. I'm just going to share my screen with you all right now. Can everyone see this?
Yes.
Okay, great. Let me just... Okay. So to get started, we're going to begin on page 19 of the police pension report. Give you a quick high-level overview of some of the risk return statistics in summary, and then we'll hop into performance and any questions you may have. As we typically do, we'll start here in this risk return summary statistics. You can see here number of periods measured in months, 210, which brings us to 17 and a half years worth of data. Quite remarkable at this point in time. Couple line items below, you'll see your annualized return over that time period, really in line with that of the plan policy, 5.47 versus 5.54. And with that comes about 9% less volatility measured by the risk statistic of beta versus that of your policy of a 1 or the market. And that's further evidenced by your risk metric or annualized standard deviation, which is 7.42 versus 8.04. We typically don't touch upon this graph, but I think it's noteworthy, the growth of a dollar chart over here on your left-hand side. As you could see, and as Charlie alluded to, over long-term cycles, the uptrend has been continuously an upward cycle. This chart dates back to April of 2003, and you can see dating through the quarter end of September 30th, 2020. You could see the blue line represents the plan, the Town of Branford Police Pension Plan, and the green line is the underlying policy. As you could see, there are periods of volatility. Although the direction of travel has continuously been up, most notably, you can see here 2008, 2009, we had the global financial crisis. Excess risk was taken by banks. We had the housing bubble collapse, sparking what was the Great Recession, most severe since the Great Depression. Coming out of that, you could see a period of time right around 2016, where we started the year with some concerns out of China. Its depreciating currency, slowing economy, Also, we were coming off a high of oil prices that slid down to about $30 a barrel in 2016. In June, what's formerly known as Brexit, or the UK voting to leave the European Union, occurred, as well as we had a soft IPO market throughout 2016. We then had the election of Donald Trump in the fall, and the Dow Jones at that point in time was flirting with the 20,000 mark. We continue on into 2018. The fourth quarter, we saw the markets bleed out a bit, and that was really due to what we recall political posturing when Trump designated trade tariffs between the US and China, and then exiting that period of time to present 2020 spring, where we had the COVID pandemic, which brought us into a steep and deep recession. And here we are, present day. So you could see over the long term, we've had bouts of volatility. This is nothing new to us, although a global pandemic has been quite the challenging none the least. So what does this mean in dollars and cents where it stands today for the plan? Let's take a look at the past quarter. Beginning market value of July 1st, 2020, you could see a planned market value of $25,107,334. You could disregard the contributions and withdrawals as that takes into consideration rebalancing activity, bringing you to a net cash flow of positive $237,098 and a net investment change or earnings for the quarter of positive $803,234, which brings us to our ending market value for September 30th of $147,666. And as we pan from left to right over these longer tenures and longer time horizons, you can see how the plan has done dating back over the 17 and a half year time period, in excess of $16 million in earnings dating back to April of 2003. Looking at plan performance in the quarter snapshot, we could take a look at the asset class level, how the plans performed. We did see a bit of outperformance for the most recent quarter, 3.17 versus 2.99. And you could see over the longer periods, just as we saw in the summary of cash flows, those numbers tend to smooth out and get closer to one another, dating back to inception, where we have a return of 5.47 versus 5.54. The underlying equities, as Rob alluded to, the emerging market allocation was the strongest performer for the third quarter, followed by your large cap domestic equities. Within your equity bucket, you have all large, mid, small, domestic, an allocation to international, as well as emerging, real estate, and master limited partnerships. The fixed income mandate, which is managed by Mesero, just slightly trailing that of the policy, but you could see year to date how it's provided some excess performance with a 45% allocation overall to fixed income and a more conservative mandate. They have done quite an exceptional job. High yield, we saw an uptick for the past quarter, although year to date it remains quite flat. And then right here, you just have your cash allocation. As it goes, the plan has continued to perform in line with overall expectations with a passive mandate, especially through the economic cycle and the 2020 journey thus far. As it stands, the assets as of Friday's close of business were $28,208,513. This equates to earnings of $2,060,000 approximately. And that also is approximately 7.9% quarter to date from October 1st through Friday's close. So here we are about 3 weeks away from the close of the fourth quarter, and the portfolio remains just shy of up 8%. We do have one action item for the board as it relates to the police pension. We would like to, pull up the rebalance so you could see. We would like to take this time. Here's your current market values of your plan as of Friday's close with the underlying asset classes. We would like to trim slight overweights to equities, roughly about $180,000. And there's about $60,000 accrued from dividends. And we want to transfer that into the cash account just to ensure the cash level is at target policy for future benefit payments.
Okay, thanks, Luke. Are there questions with regards to the presentation on the police pension fund? And
Chairman Mooney, this is Lisa Arpin. I just would like to state that if anyone is on the telephone and they may not be aware of this, to mute or unmute themselves so they can speak. It's *6 to toggle between the two. Thank you.
Thanks, Lisa. With regards to the Rebalancing Act, Jim, you've gone over this with the folks.
Yes, Joe, we met this afternoon to discuss it, and primarily that rebalancing will give us cash for net pension outflows to the end of February.
All right, thanks. Somebody want to make a motion with regards to the rebalancing?
Harry D'Adamo will move it. Or second it.
And I'm taking Harry move the motion to rebalance the $242,613 per the recommendation in the sheet that's been provided to us. And I believe Jeff seconded it. Is that true?
Sure.
Yeah, he did. Discussion from the board? All in favor?
Aye.
All right, Luke, that's good. You want to move on to the fire pension, the fire incentive plan?
Yep. So here we have the Town of Branford Volunteer Fire Incentive Plan, ending quarter September 30th. Some of the same highlights we saw in the police, just a shorter time horizon. You have 58 months or 4 years, 10 months worth of data. Your annualized return, 5.12 versus policy of 5.51. However, this also comes with about 9% less volatility, as well as a lower risk quotient, annualized standard deviation 8.58 versus the market or the plan policy of 9.37. We take a look at the summary of cash flows. We had a planned starting value in July of $1,157,837. Disregard the cash contributions and withdrawals due to rebalancing. However, that brings you to a net cash flow of $76,988 and a net investment change or earnings for the quarter of $37,667, bringing you to an ending market value of $1,272,493 for the quarter. And in similar fashion, if we pan left to right over the time period, we could see dating back to inception of December of 2015, the plan has had earnings in excess of $232,000. Taking a glance at near-term performance for the quarter, we also saw some outperformance over the 90-day snapshot, 3.22 versus policy of 2.99. As Rob also alluded to, the equities prevailed the majority of the quarter. We saw a large uptick coming out of the second quarter, which carried forward into the third quarter. Your fixed income mandate pretty much muted for the quarter. However, looking at year to date, we have seen nice returns out of the fixed income mandate. In the volunteer fire plan, we do use an entirely passive mandate, with the exception of the high yield component, which is managed by Mainstay Mackay High Yield Fund, which also performed quite well for the 3 month. And overall, the plan has continued to carry along throughout not only the recession, but the nice snapback recovery. As it stands as of the close of business this Friday, the current assets for the fire plan are $1,382,635, which equates to earnings of approximately 8.6% quarter to date from October 1st through this past Friday, December 4th. And in dollars and cents, that's about $110,000 of growth over that period of time. At this point in time, we have no recommendation to rebalance the fire pension. The assets remain in line with the overall allocation, and we have ample cash to meet benefit payments. So if there are no questions, I can move along to the OPEB trust.
Okay, questions from the board with regards to this fire incentive plan? I think we're all set, Luke. We'll move on to the next.
Yep.
Fine.
Last but not least, we have the Branford OPEB Trust, which also has a 55% equities, 45% fixed income mandate. You have here 111 months of data, just over 9 years worth. You can see your annualized return, slightly trailing that of the policy over that time frame, 5.02 versus 5.13. Substantial less volatility, however, approximately 17% less than that of the overall market. And that's really due to not only the methodical nature of our rebalancing throughout all the plans, but also due to the cash balance that we have held for some time. We also have a risk quotient due to your annualized standard deviation, 7.03 versus 8.08. The OPEB Trust, with a beginning market value back in July of $23,545,392, just saw a small negative cash flow due to rebalancing of $12,722. However, we saw a net investment change or earnings in excess of $600,000 for the quarter, bringing us to an ending market value of $24,134,297. And over the inception cycle dating back to July of 2011, you could see net earnings in excess of $4.9 million. If we pan ahead to page 15, you can see all the underlying holdings, which gives you a little clearer picture. What's owned in not only the OPEB, but the majority of both the two pension plans as well, with the passive mandate throughout your equity groups. Your high yield and fixed income are managed by Mesro Financial in the fixed income suite, and the Mainstay Mackay High Yield in the high yield bucket. We did see some outperformance as well, just slightly, with an uptick of 2.56 for the quarter versus 2.43 for your policy. And as we carry out over the longer time frames, you could see the plan and the policy tightening up that gap dating back to July of 2011. Most notably, as I mentioned earlier, you can see your emerging markets leading the way for the quarter, followed by your large cap equities, which we have exposure, broad exposure through the passively indexed S&P 500. As it stands as of Friday's close, the OPEB assets are at $25,865,119, which equates to approximately up 7.1% quarter to date. And also at this time, the policy remains within the corridors for its target allocation. It also has ample cash, so there is no recommendation to rebalance the plan at this time.
So, Luke, what's going on with the MLPs?
So your MLPs, we have an exposure of about, you have an allocation, of about 5%, 5.25% to your master limited partnerships. Master limited partnerships are your, for those that don't know, are your gas, oil pipelines, really transportation of commodities. As we're well aware, oil has come over quite some strain and distress over the year, especially as the economy is still in its recovering stages. Although we hope to see the light at the end of the COVID tunnel, the reality is there's not a lot of planes in the sky, not as many cars on the road. Manufacturing has taken a hit. So we are very cognizant of this space and this allocation. At our last Board of Finance meeting, when we did rebalance, we decided not to allocate dollars at that time just because of the sensitivity around this market. The one thing to note, and if you want to take a quick look here at this market value, $626,000 in the OPEB trust as of September 30th. I'll show you where we stand present day. So it's $626,000 as of September 30th. And as of Friday, you could see it's jumped dramatically, just shy of about a $300,000 increase. MLPs quarter to date are up 46%. So within about 10 to 11 weeks, we've seen a robust recovery from the MLP space. So although it's a small allocation, we could see it was at about 2.5%. Right now it's at about 4.5%. So we have seen some headway, especially with the new administration coming into play. There's been some talks. Trump's administration with deregulation has been quite favorable for the oil and gas commodities. Someone like Biden-Harris ticket, there might be more talk of clean energy. However, that can play in the favor of MLPs because of existing structures, could be a value add due to barriers of entry. So we are seeing a bit of volatility nonetheless in the space. We still are going to hold and pause on the asset class. We still feel like it adds diversification. It also offers a large distribution in terms of income as it pays dividends. It acts more as a toll road. As you transport commodities through it, fees are generated. But the asset class as a whole has come under some strain, and both GYL and Andrew Group are cognizant of that and continue to monitor those developments closely.
Thank you, Luke.
You're welcome.
Any questions from the board with regards to this OPEB trust? All right. Thank you, folks. Appreciate the presentation. And that's all you need from us at this point, correct?
Correct.
All right. Thank you.
All right. Take care, all.
Thanks. Yep, same to you. Okay, we'll move on to the agenda item number 5, which is to consider and if appropriate eliminate the position of Assistant Fire Chief Fire Marshal and create it and fund the position of Assistant Fire Chief and position of Fire Marshal. And we have a letter from the Fire Commission and Fire Chief, and we also, so they can make their presentation. I might note that Traditionally, we try not to set a precedent or make changes mid-year if we can avoid it, and try to take care of the personnel additions and such at budget time. When we do consider changes midstream, we try to do it on an exception basis so it doesn't set a precedent. So with those comments, I'll welcome the chief and the commissioner from the fire department.
Thank you, Chairman Mooney. So yeah, we apologize for coming mid-year. We certainly understand the system, but with the retirement of Assistant Chief Sean Heffernan, who's also, he held the title of Assistant Chief Fire Marshal, position that over 20 years has grown rather cumbersome and large for any one person to hold both those titles. So we wanted to take this opportunity to continue with our kind of restructuring the staff positions to be more efficient and have some continuity. With that, we're separating the Assistant Chief and the Fire Marshal into two separate positions. The Fire Marshal really, and it's almost like a division of the fire department. It needs, it deals with over 2,275 inspectable buildings every year, plan review, complaints, and investigations. And there's a large workload for much more than one person to do right there. And the Assistant Chief position is, my second in command, primarily involved in day-to-day continuity among the four shifts on the operations side of the fire department. When, certainly someone I can rely on to do special projects, and it would be the non-union position. The fire marshal's position would be a union position. We would like to take the position that's currently the fire prevention inspector, elevate that position to become the fire marshal, and then have the assistant chief position, non-union, stand on its own. With that, we would propose to increase the salary of that position, again, non-union, non-overtime, and we would eliminate the considerable comp time that position enjoyed in the past, and strictly just leave it at that, this is the salary of the position. And so that salary would be 105, which is, well within line between the, for instance, the deputy police chief and the police chief, and the fire marshal position, which is a union position, would make slightly more than a deputy chief of operations because they also hold that special skill. Instead of, they used to have a stipend attached to that. Instead of having a stipend, we just put it into the salary because essentially a stipend is for doing more than your normal responsibility. And this is their job. So we figured that was fair. The increased cost to the current fiscal year would be paid for out of the, currently we have a vacancy in the assistant chief's salary. We haven't been paying anybody since October 31st. So the 2.5 months, we estimate, by the time we are able to fill this position, would more than cover the cost for this fiscal year.
Okay, so there's no transfer request in this fiscal year for that position? There is
no transfer request due to the surplus in the salary account. That's correct.
And what happens for next year? We're not adding another position next year, are we?
That's correct. So we would leave the position that we're elevating the fire prevention inspector's position as a non-funded position. We, certainly envision funding that at some future date, but for now we have deputy fire marshals who could work to cover the, the excess inspections and whatnot, which they've been doing anyways on overtime. We feel that, at least for now, we can get away with that. Now I say for the foreseeable future, I don't see me coming to you next year and asking you to fund that position now.
Thank you. Commissioner Massey, you have any comments you'd like to make?
Yeah, I was going to say, I was going back in time and telling the chief that back in 1962, back when we became really a paid fire department, John H. Tweed was our deputy fire chief, and he was our fire marshal, and John Swankovic was our fire chief. And the fire commission back then eliminated the position of the volunteer chief and made it fire chief, fire marshal. So we're kind of going back and correcting something that was made back then, because I think we did 300 calls back then, and now we're doing just under 7,000. So I think our amount of businesses and what we have and the amount of code, so it's really needed. It's overdue. Now it's, like the chief said, probably 20 years in the making, but I know it's 2020, so we really have to look at this now. So we're going back to something that we had. You know, it was changed back then, and it's just something bringing it back to really where it should be right now. It's really a position that's really required to have its own niche in the department as the fire marshal and the assistant chief separate.
Okay, thanks, Commissioner. Questions from the board?
Joe, if I may, I got a couple of questions. It's Jeff.
Sure.
So, Chief, can you elaborate on what the fire marshal's responsibilities are in comparison to the deputy fire marshals? And is the fire marshal considered part of the count in any response in town outside of investigations and things of that nature?
So Jeff, currently the fire prevention inspector, we all are responders, and that's just the truth of the matter. So we do, we run a one call at a time philosophy in this department, where if all of our resources are down and you're a certified firefighter, you're going to go to the call. And that includes myself and the fire marshal and the assistant chief. So at the end of the day, we're all responders. The fire marshal's job is really to manage the inspection cycles. Like I said, we have 2,275 inspectable properties. By statute, we're required to inspect them, most of them annually, depends on the occupancy. But if they hold a healthcare license, a liquor license, those types of things are annual inspections. So a lot of the multifamily houses are annual inspections, anything that's multifamily. So we have a lot of, it's really 3-family and above that we're talking about, and the town's loaded with those. We just haven't been able to get to a lot of these, and we're the current fire prevention inspector, Rob Dobozinski, is, been managing since Sean's departure. He's doing a great job. And the deputy fire marshals are primarily just going out and doing the inspections under his, direction. So he would manage the plan reviews, the new construction, manage the inspections, and manage the deputy fire marshals, who are really the boots on the ground going to cover a lot of the inspections in the multifamilies and that kind of thing. But the fire marshal is your 5-day-a-week position. So that's really the difference between the two. And the fire marshal statutorily has the final say. So if something's going to be signed off on, it's the fire marshal.
Understood. So when Sean Hefner was on duty, what did the deputy fire marshals do under him?
Well, under him, we created the fire prevention inspector position, and that was kind of the full-time doing what the deputies would be doing. And we did utilize the deputies too, Jeff. You got to understand, there is a ton of work for these guys, and like most municipalities, you can only afford so many full-time positions to get it done. But in reality, we could easily support the fire marshal with 2 full-time positions. But, we just know that's not reality. If we're going to allocate manpower, we look to prioritize it to, all the different jobs that we have to do.
And I understand that. And I understand there is a large workload based on, the housing and the development that goes on in town and the plan review and all that kind of good stuff. Just trying to get it all in conceptualized based on, we have 4 deputies on each shift. And we have a fire marshal.
Right. So the deputies on the shifts, Jeff, are our operations side. So they're responders in the street. They don't typically do fire marshal work or code inspection work. Different than the deputy fire marshals, which are people who have gone to the Connecticut certification class and had earned the certification and been appointed as a deputy fire marshal. Right now, those are all rank and file members, except for Michael Stackpole is the newest. He's also a deputy chief, but he holds a deputy fire marshal title as well. So it's the education and the certification to be able to do that. The deputy chiefs are your shift commanders. They're out in the street doing the day-to-day operations, working with the shifts, training, and going on calls. They also work on operational SOPs and that kind of thing.
Okay, thank you. Do you think it's possible by the time the budget season comes around, we can get an organizational chart of your department so we can see how they're all laid out?
Absolutely.
Thank you.
I can probably get that. Yeah. Yes, Bob.
Yeah, just a question on the plan review, Chief. What are these single family, or are they just anything over a 2-family and commercial? And how do they coordinate with the P&Z and building and?
So the whole building department, planning and zoning, and the fire marshal's office work as a team. And the permitting process starts with the building department. They submit their plans through the building department, and then the fire marshal's portion of that gets sent over for our review. And then once, we both departments together have 30 days to review plans. We submit them back after review. During the process, we'll communicate back and forth with architects or other, people as necessary. But then throughout the entire process, we go out and do the various inspections as a team. So you'll see planning and zoning, building, and the fire marshal for new construction going out to do these various inspections during a new construction as a team. And then after that depending on the occupancy of that building, it becomes an inspectable property that then has to be, often annually inspected.
So this would be commercial properties.
The majority of it's commercial or multifamily. We only deal with anything above a 3-family and other commercial occupancies. So 1 and 2 family homes, the only real portion of the fire code is detection in those occupancies. Other than that, those types of 1 and 2 family homes, those are all primarily handled within the building department. Does that make sense?
Yep.
So, Harry, do you have any question?
It was only in how many of the so-called deputies or the field people we have are they what I would call the full-time members of the fire department with this additional duty? Could you clarify that, Chief?
Yes. So we have right now 5 deputy fire marshals, and that's a title within the state of Connecticut statute. So you can have an inspector, a deputy fire marshal, and you only have 1 fire marshal. And so yes, it's a part of they were trained and educated, and once they were eligible to be certified, we certify them. So we allow up to 6 people to hold that title. We don't always have work, or we limit that amount of work. Currently, 4 of those are career people, and 1 of them is a volunteer.
Thank you.
Did Charlie have a question?
Yes, that's it.
Okay.
Joe?
Yes, Charlie.
Hey, Chief, on this is Charlie Sheldon. On the fire prevention inspector, is the thinking it's going to be a new hire or maybe an advancement of somebody within the department?
That's the position that we're elevating right now. We're hoping that the person, we have several eligible candidates within the department that could be promoted to that position. We would have to post it and go through the process, but we're confident that it would be within the department.
It'd be pretty awkward if it's not funded again.
It would be.
Yeah. Thank you.
Okay. Victor, any question, or are you good?
I'm good, Joe. Thanks.
Okay, so the request here is not necessarily for monetary transfer, but it's to approve the position, I would say, and as the agenda states, to eliminate the position of assistant fire chief and create and fund the position of assistant fire chief separately and fire marshal. Jim, do we have a motion on this, or is this a specific to line items, or is this just a general motion?
Yeah, that would just be a general motion. And you alluded to the reason it comes to the Board of Finance earlier in the meeting back in, I think it was 2001. Personnel decisions that affect future budgets would need to be acted on by the Board of Finance and the RTM. So I think if you approve a general motion related to the request, there's no to's and froms, but it's eliminating the position of Assistant Chief Fire Marshal, and as you said, and creating on the position of Fire Chief and position of Fire Marshal. So Assistant Fire Chief and Fire Marshal.
Thank you.
Joe.
Pardon, Jeff?
No, it was Bob. I said I'll move it.
Okay, thank you, Robert. Motion's been made by Robert. Is there a second?
I'll second it.
Second from Victor. Additional discussion by the board? All in favor?
Aye.
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 Opposed? So carried and unanimous. Thank you, Commissioner and Chief Mahoney.
Thank you, guys.
Commissioner Massey. Take care.
Thank you, Margaret and Jamie, for your help.
Thank you.
Yes. Thank you. Okay, next is item number 6, to consider and if appropriate, approve a transfer from the Board of Police Commissioners as follows: from regular salaries, $4,558, and for stipend for the same amount, $4,558. Chief, welcome.
Good evening. I appreciate your time. This request is for a transfer into a stipend account, as stated, for roughly $4,500. The stipend is going to be assigned to the crime analysis, who is going to assume the role and responsibilities of a CALEA accreditation coordinator. To quickly summarize this for you, one of my goals in setting forth in the future was to attain CALEA accreditation for the agency. For some of you who have been longstanding members, or you recall back in, I believe it was 2007, Branford was an accredited police department. However, that had lapsed. It is also my understanding at that time during the process, they had hired out for a consultant to assist in the process. Moving forward, coming from an agency that was CALEA accredited, I do have some experience in doing it and getting off the ground. And I do know that it's a heavy lift. It's a 3-year cycle. And the first few years of your process is the most difficult. I think we're well suited. We're in a very good position to accomplish this, but it is a heavy workload, and it is responsibilities and more work that we don't currently have. And the fire chief alluded to, we try to run lean with personnel. So in working with Margaret Liberta, the director of HR, we felt that a stipend would be the best way to try to accomplish this in a cost-effective manner. And the reason why the crime analyst, the skill set that she has and the roles and responsibilities that she currently does, it dovetails very well with this process in compiling proofs of compliance, compiling reports, and keeping the project on track and on point. One of the biggest problems with accreditation is agencies will pay the fee, which is roughly $12,000 to start the process. But they can't follow through with it because it is a huge commitment. Ironically, even though we had started the process this year during the special session, they passed the Police Accountability Act. And within that, they have it, as it stands today, that all police agencies in Connecticut within 5 years are to obtain CALEA accreditation. Now, it's an unfunded mandate, and I will tell you that it's going to be a high lift, a heavy lift for many PDs. But we were already on that track and working on our updated policies. We're in good position. So with the stipend, what that allows us is some flexibility over this 3-year period. We get through the heavy workload, we assume we get our accreditation, and there is, maintenance and upkeep of the program. It's not like you just stop doing it, but we can reassess the workload at that point in time. So the flexibility of the stipend is beneficial to us. I will tell you, with the crime analyst's current salary, with the addition of this stipend, we're still roughly $18,000 below some comparable PDs that have a position of an accreditation manager. I'll spare you the time of her roles and responsibilities. It's very vast, but she does have the skill set. And I think this added responsibility is well deserving of this stipend. So I request your favorable approval.
Thank you. Thank you for the presentation, Chief. Questions from the board?
Joe, I have a question.
Victor.
Chief, you mentioned $12,000 to get the process started. Do we have funding for that?
Compliments of your local Connecticut drug dealers. Yes, we've paid that through our asset. Yes.
Joe, I have a question.
Sure, Bob.
Chief, so she becomes the compliance officer for the department. Is that correct?
There's different terms. Basically, I would say kind of the point person or the driving force behind the project to make sure it's on track. There's a lot of work. It's all electronically done now. The policy creation and policy review is done at the administrative level, obviously, and sometimes in conjunction with our legal staff. But it would be, I think, accreditation coordinator, but she will do the deep dive of digging for the compliance and ensuring that we have the proofs. What I mean by a proof is we have policies that say we will do X, Y, and Z. Well, it's easy to have a policy, but you must show that you are complying with X, Y, and Z and give examples. So that's where the labor comes in.
Okay. And then this would be a yearly stipend, so you would come back every year for this particular stipend?
Yeah, it's a stipend account, so I think I'd have to either transfer or yes, in this budget I could include it. But again, I'd like to reevaluate it once we do get the accreditation and kind of get a sense and a measurement of is this fee still appropriate at that point?
Great, thank you.
Hey, Joe, I have a question.
Charlie, go ahead. Yes.
Hey, Chief, so I heard you say that there's a mandate that came down that you have to have this CALIA accreditation within 5 years. And my question is, what's the downside? Supposing you don't get the accreditation, what happens?
Well, the first thing is when you look at what the accreditation does for us, it really does give you an internal look of your operation. It keeps you on task. Our reporting requirements now to the state of Connecticut and other federal agencies is very vast. And we actually have a calendar of when we need to report certain police activities. So for me, and in my experience with it, is it assures that your policies are up to date. It forces you to do internal checks on your operations, some enhanced safety issues. There is some bonuses when you look at your insurance and our liability for lawsuits, which again, now the lawsuits are able to flow on the state side in response to this police bill. So, it does give us some civil liability protection. It assures the public that we are adhering to the best practices in the police world. And I think it's an issue of pride too. There's a lot of work. This won't be just her undertaking. This is an administrative undertaking. It's a line officer undertaking. The line officers will have additional reporting requirements. And we think of areas specifically like jail management, where there are very strict protocols that are what we should be doing and we are doing. So I believe in it. If we didn't do it, we could get by with doing it at our direction and adhering to these. But if we're going to do the work, we deserve the recognition.
Okay, thank you.
Thank you, Chief. Margaret, you're comfortable with the stipend amount and the process?
Yes, Joe. The chief and I and Jamie have been working closely together on this. We feel the stipend. We went back and forth on examining whether it should be a full-time job or a stipend, and we feel that this is the best approach for the town. We are very, very fortunate to have an internal candidate who can take on the job responsibilities, and she's already demonstrated that, which is great. And I think thirdly, we're very fortunate that we haven't had a grievance against us from the union saying, giving us a person more responsibility when we really haven't had the opportunity to, give her a stipend or some kind of reward. So she's successfully done the job. She's proven that she's got a good track record. She's got the support of the chief and the deputy chief in her role, both as a crime analyst and in this new role, 100% behind it.
All right. Thank you. Jamie, your any comments?
Joe, just to say I fully support this request by the chief, and I think Margaret added to it, touched upon it. We did evaluate this. We've discussed it for a while. We do think that this is appropriate.
Okay. Somebody want to move this?
I'll move it, Joe.
I'll move it, Joe.
Okay. Robert, you moved it, and Charlie, you want to second it?
I'll second it. Yep. Thank you.
Okay. Not the any discussion or questions from the board? All in favor?
Aye.
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 Opposed? So carried by unanimous vote. Thank you, Chief, and good luck.
Thank you.
Take care. Okay, item number 7 is to hear an update from the finance director on the FEMA fund as per the attached summary of revenue and expenditures. Jim Finch has provided us with an overview of the activities from the FEMA funds. Jim, you want to run through this briefly?
Yeah, I just touch on it briefly. As we've been talking, probably even back at the end of last year, going into this year, that we really have a number of events that are exceptional. The elections, the storms, and of course the expenses associated with COVID-19. We mentioned before that the FEMA response in terms of what they determine as an eligible cost has been less than robust. We did, since we last spoke, get a small commitment from FEMA. It looks like they're going to give us about just shy of $18,000. We did receive about $82,000 from the state coronavirus relief fund. I did get an email at the end of last week that the state is looking to distribute more CARES dollars to municipalities for COVID, and they're looking to do so on a formula that's somehow linked to population. So again, that could be good news for us. Clearly, we'll get something. I haven't seen any estimates on the amount. And while we certainly can't count it, there may be new relief programs out of Washington. During the pension and OPEB and presentations, we talked about policy changes with the new administration. It's possible that there may be some more dollars for local governments or states flowing to local governments. And we still have some small Board of Ed offsets because the Board of Ed, some stuff was charged to the FEMA fund initially, but working with the Board of Ed, we know that there's another funding source for that as well. So this is something I kind of anticipate providing regular updates to the board and most likely the RTM as well. And one of the challenges I think we have is that clearly these are large dollar amounts. These are significant events. Most of the one that really impacted us quite tremendously besides the COVID was the 827 storm, which, by far is the largest expenditure out of that fund for this fiscal year. There is no declaration as of yet. There's no declaration for Isaias. In the event we get a declaration, then we have a chance to recover some dollars there. But right now, there is none. And hopefully at the next meeting, I'll have some news in terms of what that formula is from the state. And then as we make it toward into the third quarter, we'll probably be looking at another transfer into the fund. Currently, there's about $721,000 in our contingency for the current year. We are in the winter months technically, so we'll see how we fare there. And we'll just continue to monitor this and update the board throughout the year.
Thank you, Jim. So at this point, if everything stays the same, we'd be needing to transfer $366,000 in order to cover this expenses of the fund, absent any additional revenues that you're able to secure.
Correct.
And absent any additional expenditure. Okay. Thank you. Questions from the board on this report? Okay, thank you. We'll move on to the next agenda item, number 8, to hear a request from the town engineer for an increase in appropriation for the town of Branford, the Branford Point sea wall and wharf improvements, and consider and if appropriate, approve the finance director's correspondingly transfer and resolution. And the proposed transfer would be from fund balance, $225,000 out of the general fund, and to the operating transfer out for $225,000 into fund 700, and the corresponding transfer in the 700 fund, which is the seawall project fund, transfer in at $225,000, and transfer in from public works. The transfer is in from public works for $200,000 and another $25,000. Actually, those would be and then the expenditure side would be the $450,000. And so the resolution would also, as required, if so desired by the board, would be that the Board of Finance recommends to the RTM an increase in the appropriations for fiscal 2021 general fund budget from $118,017,243 to $118,242,243. This increase will be funded through an appropriation from fund balance and be used to increase the budget for the Branford Point sea wall and wharf improvements. And thank you, Jim, for that. And for now, why don't we ask our town engineer, John? How are you? You want to present your request here?
Sure. Thanks, Chairman. So as you guys, the board may remember, back in August 2019, we came to the Board of Finance for appropriation to repair a partial failure of the seawall at the Branford Point. We'd asked for $225,000. I believe the Board of Finance and RTM had appropriated $200,000 with an additional $25,000 coming out of an existing capital budget from the Public Works Department. Once we brought the design engineer on board, we got a full design, which I included in your materials there for anyone interested in looking at them. We did find that, for one, the bedrock was fairly shallow in a couple of places where this wall is going to be repaired, as well as a lot of the wooden wharf structural elements are pretty well deteriorated. I think it would be prudent to repair or replace those components at this point, because the contractor will be taking all that up in order to access the seawall. So this would be a good time to replace those structural elements as well as the all those heavy timber elements that are there. So the additional costs are coming in the rebuild of those timber wharf items, as well as having to, when you drive those piles, you have to have sufficient mud depth in order for those piles to be able to really hold all the weight of the heavy timber. So if we don't have that mud depth, which we don't in a lot of these areas, we have to really drill into the rock and create, a good solid base for all those components up above. So it is adding a lot of additional costs. Just the nature of this project, we've built in a good sized contingency, as I don't want to come before you guys again for additional funds. So at that point, we're looking at an ask of a total ask of $450,000 with the transfers that the finance director is proposing.
So would this get bid out, John?
Yes. So we do have the coastal engineer would be retained as the construction administrator on the project. That's their forte, and then the project itself is ready to go out for bid. So depending on the weather and the forecast we're looking at, we obviously want to get this done before the busy season in the late spring, early summer. So we would go out to bid probably sometime in January, February to retain a contract.
Okay. Thank you, John. Questions from the board, from John or Jim, if need be? So if there's no questions from the board, is there any interest in transferring this? If so, I'll entertain a motion as for the resolution.
So moved. Harry here.
Harry?
Yeah. Yes, moved it.
Yo, Jeff, I'll second it.
Okay. So Lisa, you've got that. Who made the motion and seconded it? And so those are for essentially the two transfers, the general fund transfer and the Fund 700 transfer, and the resolution that increases the budget. And so motion has been made and seconded for those transfers. And any other discussion? If not, all in favor?
Aye.
Aye.
Aye. Okay, it's any opposed? It's hard to see hands, so I think there is no opposition, correct?
Correct.
That's correct.
Okay, thank you. It was unanimous. And John, good luck and thank you.
Thank you all.
Okay. Next is number 9, item number 9, which is to hear a request from the finance director regarding Foot Park appropriation for increased revenue fiscal year 2020, and to consider, if appropriate, approve the following transfer and resolution. And it will be a general fund transfer to increase the revenue piece, Foot Charitable Trust for $50,000, and increase the transfer out on the expenditure side for $50,000. And on Fund 700 side, there would be a transfer in of $50,000 and an expenditure authorization for $50,000 on Foot Park tennis courts. And this corresponding resolution, in addition to the transfers, would be resolved that the Board of Finance recommends to the RTM an increase in appropriation for fiscal year 2020 general fund from $116,119,944 to
that should be 169,944.
$169. Okay.
Yeah.
Now this is in coordination with the resolution prior to this that had the 118 million, Jim.
The 118 million was for the for the new year.
Yeah. I got you. You're bouncing between the 2 years. So it's 116, 169.
Correct.
All right, so I will start again. Resolved that the Board of Finance recommends to the RTM an increase in appropriation for the fiscal year 2020 general fund budget from $116,169,944 to $116,269,944. This increase will be funded through an appropriation from increased estimated revenue received from the Foot Trust and will be used to increase the budget for the tennis court improvements at the park. Okay, Jim, you want to?
Yeah. So this transfer is essentially to reflect the additional revenue that we received from the Foot Trust. In a typical year, we would receive $200,000 from the Foot Trust, and normally that would be $125,000 for operating and $75,000 for capital. And so that would be $200,000. In this case, we received an additional $50,000 for capital, and that was related to the request the director had made for the Foot Park tennis courts. And there were other dollars that were allocated for this project. Primarily, the rec board had an allocation of $175. By increasing the budget and moving these the foot dollars on the capital side stay with the project. If at the end of the project there's dollars left over, then it would be my thought to then have that go back to the rec fund, because the rec fund spent $175,000 to add to the project. So and the year we're looking to still close out our year. So we had this opportunity to make this old year transfer.
Okay, thank you, Jim. Any questions from Jim on this? And
okay.
Any questions from the board? If not, I'll entertain a motion to accept
I'll move it, Joe.
Transfers.
I'll move it, Joe, Charlie.
Thank you, Charlie. Is there a second?
Jeff will second it.
Jeff seconded. Thank you. Discussion? All in favor?
Aye.
Aye.
Opposed? So carried. Thank you. Thank you, Jim, for that. Item number 10 is to request from the Finance Director to continue discussion on the James Blackstone Memorial Library Endowment Fund updated on sustainability project. Jim has spent a fair amount of time with not only officials at the library, but also our financial advisors that are involved with our pension plan, but are also involved with the library board, and with regards to the endowment and how it impacts their ability to add finances to supplement the town funding of their budget. So with that, I'll turn it over, but I just want to recognize Jim for all the good work you've done on this, along with your other team members. Traditionally, over the years, we know that we've encouraged the library board to preserve their endowment fund, to take the prudent amount of withdrawals to supplement their budgetary revenue side. And I know while it's put additional demands, let's say, on the town's contribution to their budget process, I think the intent from the Board of Finance's standpoint was, again, to try to preserve as best as possible the ability for the endowment fund to maintain itself and to earn the conservative amount of income that could be pulled away, but did not necessarily detract from principal. But with that, Jim, you've done a lot of work on it, so I'd like to turn it over to you.
Okay, and I've also worked with Adam Spelka, the treasurer at the library, and as you mentioned, our advisor we have on the pension, who is also the advisor for the library, and that's the Hightower Group. working with Rob and Charlie in the background and Eric. So what I thought I would do is attach to my memo, there's kind of an outline for the continued discussion. And I started where we left off at the last meeting, and that was a question with regard to if there were any restrictions on the endowment. We did look at the audit report, which the library provided to us. And in talking with the folks at the library, there's a restriction of $25,000. So as a practical matter, I think it's fair to say the balance of the endowment is largely unrestricted. The other element to this was we wanted to do some revised updates to the Monte Carlo analysis. Just as a review, the Monte Carlo analysis uses a variety of assumptions and runs nearly 1,000 portfolio models of different events, scenarios that are occurring, and to see how sustainable withdrawal rates are. The easy way to think about it is the more money you take out, the less likely that your money is to last. And as Joe has mentioned, and we've mentioned at the last meeting, our goal is to make this last indefinitely, which is a tall order. It's most of us, when we do our retirement planning, we're not planning for an indefinite time horizon for obvious reasons. And in the letter, I did attach a good number of pages on the analysis. And I know Adam is on the call, and I know Rob and Charlie are on the call. And so what I thought I would do is, in terms of the analysis, kick that over to Rob and or Charlie, and then when they're done, I'll continue going through the outline.
Thank you, Jim.
Great, Jim. Thank you. So I'm going to keep it at a high level, and we could dig in as deep as you want. Jim did a great key takeaway summary of the scenarios we identified as substantive, which is looking at the income distribution rate off of the endowment. We used a strike value of the June 30th value of $2,750,000, which we rounded off for simplicity in mathematics. And as you can see, the income distribution rate, and we look at the probability of those dollars persisting beyond 30 years, is what we're looking for. And we're looking for this on a forward-looking basis with lower return assumptions. And as I indicated in a prior discussion with the board, some of the challenges that we're confronted with regards to the returns on conservative assets, and them, the potential for them to not provide flat or negative returns on a near to intermediate term basis. So when you look at that, obviously the lower the income distribution, the longer the endowment can persist. So in Jim's notes, his initial recommendation of a 3% withdrawal rate, the 3% withdrawal rate gives us, on a Monte Carlo basis, an 86% probability of the endowment sustaining beyond 30 years. 86%, meaning that in 860 of 1,000 trials of varying return scenarios and inflation scenarios, that the endowment continues to persist with a substantive value beyond 30 years. When we forecast this out to 50 years, the analysis becomes very difficult because the dispersion becomes significant. So we arrived at 30 years of being a reasonable analysis period that can be a starting point, and that should be reviewed on a regular basis. So, but that would give us a starting point of a distribution from the endowment of $82,500, and then we would look to inflate that on an annual basis to keep up with the inflation costs of any operating entity. So that's the simplest version, the simplest summary of the Monte Carlo. When we look at that at 3.25% and 3.5%, you can see how the probability declines to 75%. 75%, in our opinion, is the lower bound of comfort, which is how we arrived at the 3.5%. Our lower bound of comfort of 750%, 750 trials out of 1,000, we have successful outcomes. That gives us a level of, reasonable comfort that you can make adjustments along the way to be successful. But ideally, obviously, the lower withdrawal rate, the better, especially in light of the challenges of where will returns be in the near and intermediate term because of all the environment that we're confronted. Jim, what direction would you like me to pursue from there? Jim, you're muted.
Thank you, Rob. So when you look at some of the data that's been summarized and Rob has talked about, I said in the cover letter that we're strongly leaning towards the 3%, although because it does provide a higher probability, and we do think that is consistent to what our goal was, which was to enhance the sustainability of the endowment so that it doesn't become a declining revenue source. Now, I do want to point out that the Monte Carlo analysis and the sustainability analysis is a little bit different than the actual way that the library does their withdrawals. What the library policy currently is to look at the average value of the fund over 3 years and then take a percentage on that. So what's happening in that scenario is that the actual returns of the portfolio in that 3-year average guide the amount that could be withdrawn potentially, because if you have 2 of the 3 years as down markets, then that's going to have an impact. The analysis that was done by Rob and company was a little bit different. It was if you start out at 3% from the 2,750,000, and then you increase it by inflation, by the inflation assumptions, how is that portfolio sustainable? We discussed the fact that the methods were slightly different, but we all felt that it was still very meaningful in terms of guiding the withdrawals and future funding. But I did want to point out that there is a difference in the way that it's done, but we don't think it's overly material. Now, in the analysis with the 3% withdrawal rate, it was 82.5. If you took what the library 2017, 18, and 19 values and did a 3.5% withdrawal rate on that, it ends up being about just under 85,000. So you could kind of see there isn't a huge difference between the 82.5 and the 85,000. So we think that if the library was to use a 3.5% withdrawal rate in a future budget, or we work together to restrict the withdrawal rate to 3.5%, we think it's still being faithful to the Monte Carlo analysis, even though the method is slightly different. So I wanted to point that out. And, we also, looked at what some of the budgetary impacts were. At the end of the letter, there's, a spreadsheet showing, projecting out the library budget by major categories going forward. I won't go into all the detail of that. However, if you took the current year and you were looking at using the 82.5, you're looking at about $38,700. If you use the other method, you're looking at maybe about like $41,000. So the question then becomes, well, what does it cost the taxpayer to essentially preserve the endowment? And so you're looking at a range, let's say between $39,000 and maybe $43,000. I want to mention that because, I know that the year seems to be flying by, and, we'll be looking at the budget in a couple months. And, I think it's good that we kind work through some of these challenges and developing a path going forward to guide us in our future budgetary decisions that meets the objective of preserving the endowment. And also, I think that one of the things we mentioned at the last meeting too was, any sort of unexpected benefits that accrue to the library be used generally, to the extent they don't have any, outstanding immediate needs, should be used with an eye towards, putting it into the endowment and preserving it. If someone wants to leave them, just say $250,000, in their will, clearly that would be something we would encourage that it goes into the endowment, provided that the building wasn't falling apart or there was some other need. But so I think that if we kind of view the library and their finances and continue to work with them as providing good services, which they do, and also preserving the endowment for the long run, that obviously the town and the library will be in a better spot. And I just want to reiterate what I said at the last meeting. This is very similar, as the first selectman had pointed out, to our arrangement with the Foot Trust, where the town basically acquired the park from the trust and gets a grant from the trust, and it works out to the benefit of the trust, because now the trust itself is more sustainable because the town has basically created that savings by doing the heavy lifting. In this case, it's a little bit different, but I think the common denominator between the two events is that you have trust that exists outside of the town's direct control that impact town services, and there are things that the town can do for the benefit of those two trusts. And we did that with the Foot Trust, and we're working towards a pathway to do that with the library as well. There was a lot of material attached to the memo. Rob's analysis, the Monte Carlo analysis was in there, as well as the outline, and towards the end there was like a spreadsheet looking at the library budget, just to give you a sense as to how what the impact is. But essentially you can kind of see that summarized, given the key takeaways. And the last item on that outline is really, if you have any questions or comments.
Thank you, Jim. And appreciate, as I said, all the good hard work you've done on this. And I think it's refreshing and good for not only our board, but also the RTM to understand some of the complexity and nuances of the finances that are involved here. I was maybe ask Adam if you have any. Adam's the treasurer, if I understand correctly. He's on the board. He's also the treasurer for the Blackstone Library. Adam, you have anything you'd like to add?
I do. Thank you very much. First, I'm delighted to announce my demotion since we last met. Over the last 5 months, it's become abundantly clear to me in working with our assistant treasurer, Janice Kochanowski, that given her a long career in budgeting and management finance, that she is better suited to the role of treasurer. And it has also become clear to me in conversations with Mr. Finch, with this board, and with Representative Preet, who is the new ex officio member of our board, that there is a great deal of work to do on this. So at last Wednesday's board meeting, Janice became the treasurer and I became assistant treasurer. So I'll still be very involved in the finance committee and the finances of the library, but with a more explicit role in education and advocacy and outreach. I would also thank Jim and Rob for all of their hard work. The sustainability of the endowment obviously is critically important to us. The other thing that came out of, frankly, our board self-evaluation this year was to enhance our relationship with the decision makers of the town, to put it in 4 or 5 words. That has already started to happen, and during the budget process, we are hoping to reach out to Representative Preet and Mr. Vailette separately before the board has acted on it, to make sure that if there are points on which we hopefully to get their understanding and to be able to answer their questions, and to avoid some of the, I'll just use the word excitement that characterized last year's budget experience. But I'm quite confident that we've already made progress on that front and look forward to more.
All right. Thank you, Adam. Questions from the board from either Rob or Jim or Adam? Okay, so thank you, Jim, for the update and spearheading this, and thank you to Rob and Charlie and Adam for the involvement and the work on this as well. So there's no action required by the board. Again, we will be addressing any updates that might come along to us, and obviously we'll be addressing this in more detail during the budget process. Okay, so with that, we'll move on to item number 11, which is to receive an update on tax collections. Again, Mr. Finch, you have an update for us, you and Harry and whoever else?
Yeah, actually, and Catherine's on the call and Bobby's on the call as well.
Okay, good.
So what we put together is we looked at the collector's report. We were unable to get some of the statistics we had before. I think once the year is closed, we'll be able to get those. We got them last time because the year was closed when it really should have remained open. So the good news is we got some of those statistics. The bad news is we had to undo that to complete our audit work, which is ongoing. The other thing that, and talking with Harry, that he mentioned, is there a way that we can compare the two? And I was looking at trying to do that in Munis, the financial system, but it's not really organized in a way that makes a good comparison year over year, because it doesn't, we just look at tax collections in general, current and back taxes. We're not, the Munis system isn't looking at them in terms of the various categories. And as the board is aware from the last Board of Finance meeting, Catherine is spending time in a tax office and learning elements of that system. And so I had asked her if she can try to run a report for November of the 2018 grand list, fiscal year 2020, and then we can compare the two versus 2021. And when you compare the two, collections at the first glance are a little bit ahead of where they were last year at this time, which I think, at first blush seems a little counterintuitive. I'm not saying it's impossible, but it seems counterintuitive. And so we reached out probably the beginning of last week to the software vendor to make sure there wasn't some flag or something we were missing in running the report. Unfortunately, we still haven't heard from them. And so in releasing what I gave you, I want to put that qualification on that, because I know human beings, myself included, have a tendency to anchor to things. And I was sort of torn between releasing it without getting confirmation from the vendor. But on the other hand, it was important to show the current year collections. And I took a little liberty just to put that in the context of where we are versus budget, and obviously we want to do better than than budget because we had built in a low collection rate. So kind of gives you a snapshot with the understanding that we may find out that we need to run the report slightly differently for 2018. But I know that this is a important exercise for the town, especially given the where we're at in the economy. I know our pension folks have netted the bad quarter and the good quarter and said there's some growth of 1%, but I don't want to be dismissive of what's going on out there because there's a lot of folks that are hurting. So and that I would think at some point will translate into the amount of money that the town collects.
So Jim, thank you. A couple of questions, and before I open to the board, is you're saying that through November, and it's either for you or for Bobby or Catherine, we've collected $58,634,000. That's the report.
Yes.
And do we know what we expected per budget? On that, you did mention the budget, and I don't see that.
Yeah, if you look at budget, there's a box that shows. I sent this out today. You see a budget-wise, we're at 58.36%.
Okay. Did that come after? Okay.
It was later in the day because we were still waiting to hear from the software vendor. So
I see.
And we just went with it.
So, but the other question I was going to have was, does this all get pooled money into the general fund, or or is the general fund account, or is there a separate tax collector account, cash account?
Basically, it flows through the tax collector's cash account. It's a separate bank account, but we have but it gets swept into the general fund.
Yeah. So wouldn't there be a way to tie the actual cash received to the report that's being generated off of Munis?
Yes, but what I'm saying is when I compare it, but to try to do it from 2018, to try to compare it and get a collection percentage versus the levy, that was a challenge.
Oh, okay. I got it.
And the Munis would not tell me, motor vehicles, personal property, and real estate.
Really? It doesn't give you a breakdown report-wise based on that?
No, I mean, think of it. I mean, the subsidiary detail is in the tax collector's report, and Munis would basically be reporting on current tax revenues.
Okay.
So it would be similar to like if one was to look at a salary account and see what a department spent on salaries, and you'd see the postings, but the detail of what made up that payroll would be in the payroll system.
Got it.
Yep.
So,
yeah, so subsidiary detail is in the tax system.
Yeah, no, I get it. It's just a little, hopefully there's a good plan forward so that we have good, better management reports for everybody to share. I think this is a good start. Bobby, do you have any comments you'd like to make with regards to this?
No, it's, we're steady bringing things in. Second installment payments are starting to trickle in. Motor vehicle stuff will be coming in shortly, and we'll be on to the next cycle of collecting.
Okay. Thank you. Questions from the board with regards to Jim's report? What report generated? Harry?
No, I just want to wait until we see the comparison with the software report, and give us a more accurate opinion. And also would like to thank Catherine for her work and the tax department for getting us at least an update. But as they all say, wait, keep my powder dry till we see
Yeah, I think that's.
Yeah.
Yeah, I just want to clarify one thing. Both of these years were run off the tax collection system. So the 18 list and the 19 list were both run through the QDS tax system. Where we want confirmation from QDS is because the collection rate of 53.7 is actually lower than the collection rate for 2019 list. And the 2019 list is the year we're most concerned about because of the pandemic.
Right.
Sure. And again, as you stated, the collections through the first half seem to be okay. Hopefully no shoes drop, as they say, either with the supplement, which should be in process now, and or the second half, which Harry's and we're all concerned about. So
correct.
Yeah.
Okay. So we'll just hope for the best at this point in time. But the other thing, Catherine and Bobby, there's probably at some point some good reports that can either be created, with training or some other type of download that I'm sure you're taking a look at some point.
Yes, we are. Yes, thank you.
Okay. Any other questions from the board with regards to the tax office, tax collections? All right. Thank you, folks, on that. Number 12. Item number 12 is to consider and, if appropriate, approve and adopt the 2021 meeting schedule. Lisa's provided that to us, and it is shows us through meetings through January for the the calendar year of 2021, and shows the budget process starting on March 15th, the Monday, the 16th, and the 18th, and concluding on the 22nd. Then based on month to month, based on the calendar and particular holidays. Any questions on this from the board?
I'll move it, Joe.
Moved by Jeff.
Second it.
Seconded by Victor. Discussion. All in favor?
Aye.
Aye.
Thank you. Okay. Good meeting. Thanks, folks, for working through the Zoom presentation. Thanks to Lisa and the BCTV folks. And with that, I wanted to entertain a motion for adjournment.
So moved.
So moved.
Motion's been made and seconded. All in favor?
Aye.
Aye.
Thank you and good night.
Have a Merry Christmas.
Merry Christmas, everybody.
You too.
And it's 9:26 for the record. Thank you.
All right. Good night, folks.
Take care.
This program was brought to you in part through the support of the Town of Branford. Watch town meetings and other videos on demand at BranfordTV.org.